The dealers are going to be back ordered. The mints are going to be back ordered. Gold's going to be going up $100 an ounce a day, not a week or a month, but a day. Well, the reason it happened is fairly straightforward, and for that we can go back a little further in time to 1998. That was the Russian default. We had a global financial crisis. We had a global liquidity crisis. It was over somewhat quickly, and it did not lead to a recession, but it was just as dangerous as what happened in 2008. And it all, kind of started in Thailand, went to Indonesia and Korea and Russia, but it ended up in my lap at a hedge fund in Greenwich, Connecticut called Long-Term Capital Management, and I was their chief lawyer. I was not the head of the risk management committee, fortunately, but I say when people mess up badly enough, it gets dumped on the lawyers. So here was a situation where this fund had lost $4 billion in about 5 weeks. And people said, well, okay, too bad for you guys or too bad for your investors, but who on earth wants to bail out a hedge fund? That's not our job, and if you're this Fed. And that's what we thought. We said, well, too bad for us, but no one's going to bail us out. But we called the Fed to explain what was happening, just to be good corporate citizens. We said, well, we see a train wreck, we're in it, we want to tell you about it, but we weren't asking for a bailout, nor did we expect one. But when the Fed realized that we had $1.3 trillion of derivatives, swaps, and options with the 14 biggest banks, they said, hey, if you guys go out, you're going to take down these banks. And that is what would have happened. Interestingly, in 98, the first victim would have been Lehman Brothers. They ended up being the first victim in 2008, but they were always kind of the weak sister of the group, all along. That was always true. So the Fed organized a bailout. They didn't do it themselves. There was no government money used, but they did what's called the convening power. They got the banks together. We put a package together, 5 days, no one slept. We worked around the clock. We got it done. And in effect, Wall Street took over our balance sheet with their own money, unwound it slowly over the course of a year, and the whole thing went away. My point is, people forget about that. It was 21 years ago. And people are like, yeah, I kind of remember that. Or if you're younger, you've maybe never heard of it. But we were...
I was living in Russia at the time.
Well,
so
you had a front row seat also.
Yeah.
And as I said, I did on the bailout. But we were hours away from the sequential closure of every stock and bond market in the world. That's how dangerous it was, and that's how close it was. Now, when you have that kind of danger and it doesn't happen, the plane doesn't crash, people tend to shrug it off. But as an insider, sitting there with the Fed and the Treasury and the head of Goldman Sachs and JP Morgan and their lawyers, and those are the people we were up against, and we did get it done. We all understood the seriousness of it. It was a deal that no one wanted to do and everyone had to do. So then what was the aftermath of that, if you will? Well, the lessons I learned, and the lessons I think everyone should have learned, is, let's get rid of derivatives, not all of them, but most of them. Let's have more transparency. Let's have less leverage. Let's keep banking and investment banking separated as they had been under our Glass-Steagall law for 80 years, which worked very well. And the government policy response was the exact opposite. They repealed Glass-Steagall. They all of a sudden allowed commercial banks and investment banks to be in the same business. So it turned Citibank into a hedge fund, for example. All the conflicts that had existed in the 1920s were back again. They repealed regulations on swaps. All of a sudden you could do swaps on everything, including oil, which led straight to Enron, which was a massive collapse in the early 2000s. So as the 2008 crisis was approaching, 2005, 2006, I'm watching this, and it's like I'm watching the same movie. I'd lived through it, lived through the horror show of long-term capital management. I'm seeing the same thing happen over again. Now it was in mortgages, so-called junk mortgages, subprime, and similar types of non-credit-worthy mortgages. The previous time it had been in international bond markets. It doesn't matter. The catalyst can come from a lot of places, but what does matter is that the system is so interconnected, and you have what's called contagion, where one sector or one player goes down, but they take other people with them, and that's a domino effect, and it keeps spreading. That's what we had in 1998. It was truncated by this bailout. That's what we had in 2008. But, the first symptoms were in the spring of 2007, and it was actually Hong Kong Shanghai Bank in their U.S. operations said, our earnings were a little below expectations because our mortgage losses were higher than we thought. And everyone's like, yeah, okay, you missed your earnings target. But that was a red light. That was, hey, something's wrong in the mortgage market, something below the surface. And then in March 2007, Ben Bernanke famously said, oh, this won't be a problem, this will blow over. Just one more example of central banks not understanding what they regulate.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
And then in the summer of 2007, you had the equivalent of a heart attack where Société Générale in France, their money market funds were closed, and then the Fed had to cut the discount rate. And then the crisis began really a year before. The acute stage was September 2008. Lehman Brothers goes bankrupt, AIG gets bailed out, etc. But it started in the summer of 2007 with early warning in the spring of 2007. So it was mortgage related, of course. And I'll give you a very concrete example. There were $1 trillion of subprime mortgages. These are mortgages that, no documentation, don't have to prove your income, very non-credit worthy. But there was a bubble mentality, a frenzy, and everyone, hey, buy a house and borrow money, fix it up, sell it for twice as much, walk away rich, and everybody was doing it. And it was $1 trillion worth. Now, mortgage default rates rarely get above 5%. 5% is really high in the mortgage market. So people were saying, smart people like Ben Stein, the financial analyst, but the central bank and others were like, well, okay, let's get crazy. Let's assume a 20% default rate, which has never happened, but just assume that's true. On $1 trillion of subprime mortgages, a 20% default rate would be a $200 billion loss, which was only slightly higher than the S&L crisis of the 1980s. Adjusted for inflation, it would have been a comparable loss. And the attitude was, well, we survived the 80s, we'll survive this. Yeah, it's bad, banks will take losses, stock prices go down a little bit, but we'll survive. What they missed is, yes, there was $1 trillion of subprime mortgages, but there were $6 trillion of derivatives. Yeah. That was invisible. So all of a sudden, 20% of that was $1.2 trillion. It's because it could be just around the corner, it could be delayed, but here's the point. Just look at recent history. And I kind of start this from October 1987. You could go back further, but that's 1987, the late 80s. That was really the rise of derivatives, the rise of link trading between the stock exchange and the futures exchanges. A lot of increased automation, faster telecommunication, a lot of the things we're still wrestling with today really emerged in the late 80s and got more intense in the 90s and through the 21st century. October 19th, 1987, stock market falls 22% one day. We mentioned that. 1994, the Mexican tequila crisis. The Fed had to use a slush fund to bail out Mexico because our Congress said no. 1997, the Asia financial crisis. 1998, Russia long-term capital management. We talked about that. 2000, dot-com. NASDAQ goes down 80%. 2007, the mortgage crisis. 2008, the global financial crisis. These things happen every 5-7 years with some regularity. It's not, you can't quite set your watch by it, but pretty close. It's been 11 years since the last one. So who wants to bet that it will never happen again? I just turned around on them and said, okay, do you want to bet your net worth, your retirement, your family's well-being that this will never happen again? How do you feel? And then it gets them thinking, well, maybe it will happen again. And I also make the point that each one's bigger than the last one, so the next one is going to be worse than you can imagine, something we've never seen maybe since the 14th century, who knows. And then I make another point, which is, because people sort of say to me, Jim, I've read your books, I've heard your presentations, I actually kind of agree with what you're saying. Would you mind calling me at 3 p.m. the day before, and I'll sell my stocks and buy gold? And I said, well, first of all, I'm not going to know the day. I can with science, with very good, kind of rigorous support, you can estimate the magnitude of it and the fact that it will happen. Timing is the most difficult. People say, well, what good is it? Well, it's like an avalanche, how does that work? Well, snow builds up and it builds up and it builds up, and an experienced mountaineer can look at that and say, that's going to collapse because it's windswept, the temperature's too warm today. You can see the avalanches coming, but it doesn't have to be today or tomorrow or the day after. But do you want to ski under it? Do you want to take that chance that, today's your lucky day or perhaps your unlucky day. And the other point I make is that when this hits, we'll all know it. I'll know it, you'll know it, the audience will know it. It's going to be too late to protect yourself. You're going to say, oh, man, maybe I should get some gold, we'll call the gold dealer. Well, if you're not a customer, they're not going to take your call. The dealers are going to be back ordered. The mints are going to be back ordered. Gold's going to be going up $100 an ounce a day, not a week or a month, but a day. And you're going to say, get me some gold, and you won't be able to get it. And I want to sell my stocks. Well, yeah, okay, they're down 40%, you're welcome to it. You've lost half your money. These things happen so quickly that when people realize the panic is on, it will be too late to get out of losing positions, too late to preserve wealth. And so what I say to people is, what are you waiting for? I'm not saying, people, when you're in my position, people love to put words in your mouth. They go, oh, Jim Rickards says, it's the end of the world, sell everything, buy gold. I've never said any one of those things. It won't be the end of the world. It could be a very different world. I'll leave you to it. But so I have no problem with the fact that Bill Gates is worth $100 billion, let's say. He actually earned it. He and his colleagues and his coworkers created something that's worth incalculable. So, trillions and trillions of dollars of value for the world. If his share is $100 billion, you're welcome to it. He earned his money. But Bitcoin, you don't earn your money. You just take it from somebody else in a zero-sum game that adds nothing to society, no value, no increase in wealth. It is gambling, except there's no casino. You just take it right from the other player.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.